Everyone wishes they can go back in time and buy Apple stock when it first founded because now they'll be millionaires. And we could say the same with Microsoft, Facebook, Nvidia, all those different stocks that if we found before the price exploded, we all would have been rich. And just 5 months ago, I found 2 stocks to invest in that are already up 40%. Let me show you guys some simple tools you can use to find stocks before they blow up to potentially get your pockets bigger. Hey everybody, this is your Young Advisor, and today I'll be showing you how to find the right stocks to invest in. But before I get into this is not investment advice. I'm not yet licensed, so just take it as you will. I'm just sharing my personal experience. But first, let me give you some information on stocks. Stocks are one of the best, if not the best, way to grow your money and beat inflation. They're at a better position for potential high returns compared to mutual funds, bonds, and ETFs. But that also means the potential risk for losing your money is a lot higher as well. There are 2 different types of stocks that you can invest in. Let's break them down. Number 1 is common stock, which is the most widely used form of stock. Being a holder of common stock grants you a slice of ownership in a company, meaning if the company grows in value, your share is going to grow as well. Buying common stock is one of the riskiest ways to invest in a company, but that also puts you in a better position to get increased gains. The second type of stock you can invest in is preferred stock, which is another form of ownership, but you can get dividend income as well. This type of stock is going to be a little less volatile as it is considered a bit safer investment. And one of the best things about it, before the common stockholders get their dividend payments, they have to pay preferred stockholders first. So that means you will be prioritized for dividend payouts. But for the sake of this video, I am going to be focusing more on common stock as it puts you in a better position for probable returns. Going into common stock, there are 3 different ways to classify one. Number 1 is a penny stock, which is normally a startup company or a company in their early years, meaning they have low assets and high liability. These are one of the riskiest forms of stocks that you can invest in, but you can also get potential for higher returns, but I won't be talking about it due to the risk. Going on to the second form of stock is what we call a growth stock. These companies are going to be in their growth and expansion phase. That being said, these companies rarely offer dividends because they want every single penny possible to be reinvested back into the company to expand operations. And considering that they're not as established, they're going to be a little bit more risky to invest in, but also puts you in a better position for probable growth. And the third type of common stock you can invest in will be a value or a blue chip stock. And in basic terms, these are already established companies, so they're really just focused on bettering their image. And since they are already done expanding for the most part, they're more likely to give dividends to the stakeholders to reward them for investing. These stocks are going to have relatively more stable prices because the investors already know that these companies perform well. One great example of this would be McDonald's because they're already worldwide and have nothing left to prove. But nevertheless, these companies still grow in value over time, making them a little bit safer than growth stock. That being said, the 2 types of companies you want to invest in would be companies in their growth phase or company in their value phase. And now we have a question we ask ourselves: how do we find these companies? Our best friend is going to be stock screeners that you can use across many different financial platforms, but the one I'm going to be focusing on is the one on MarketWatch. What a stock screener is basically a tool to filter out companies based on the requirements you want them to meet or exceed. So if you want to find companies that only make more than $100 million a year in net income, then it will show you all those companies that do so. With MarketWatch, you can set 5 different filters, and I'll walk you through every single one of them. Number 1 is going to be the price filter. There's really no golden range on which stock price to invest in, so at the end of the day, it's going to be up to you on how many shares you want to be able to afford and own. But one thing to keep in mind, companies try to keep their stock price low to make it more affordable to get more investors involved. But bottom line, stock price doesn't affect company performance at all, so it can be $500 a share, but if it's meant to grow, it will grow. The second filter you can do is the volume. If a company has 1,000 volume, that means a total of 1,000 shares for the day were either bought or sold. Try to keep this at the very minimum of 100,000. That avoids liquidity risk, so you can buy and sell pretty much whenever you want. Because if a stock had 100 volume and you had 5,000 shares to sell, chances are you're not going to be able to sell all of that. So you would have to drop the price considerably to get that sold, which is the last thing we want to do because our goal is to make money, of course. So in other words, the more volume a stock has, meaning the more established they are, because traders are aware and confident in the prices. But being more established is not always the case because some boohoo company can explode out of nowhere because they made the headlines one day on a scandal or something new they invented. Going on to the third filter on MarketWatch is fundamentals. One of the best ratios you can use to value a company is the PE ratio, or price to earnings ratio. It is used to measure if a stock is overvalued or undervalued. For example, if a company had a PE ratio of 1, that means every $1 invested to that company earns $1 in earnings. This might be a little confusing to understand at first, but let me break it down with an example. Let's say I started a company and issued 500 shares for $1 each, meaning my company is valued at $500. Let's also say this year my company made $100 in net income. That would put my PE ratio at 5, so that means every $5 invested into my company, I made $1 in return. That would basically mean my company is 5 times overvalued because you would be spending $5 just to get $1 in return for your share and ownership. But you're almost never going to find a company with a PE ratio of 1 because because investors are always going to find more value in a company than it's actually worth. So in the case of growth stocks, they're normally going to have a PE ratio of over 20 up to the hundreds. That's because they are in their growth and expansion phase, and all the investors anticipate higher growth in the future, making it overvalued. For example, Tesla has a PE ratio of 174, meaning it's 174 times overvalued than what it's worth on the books. That most likely means that the investors believe the price is going to go up. But for value stocks or companies that are already past their expansion phase, it's going to be more average to find a PE ratio of about 5 to 20, ideally. Since investors of value stocks don't believe the company is going to grow way too much in the future, they already believe that the current price is what the stock should be worth. Going on to the second part of fundamentals, we're going to talk about the market cap. This is what a company is worth on the market, meaning all the shares outstanding times the share price. So going back to my previous example of my company with 500 shares, if all of those shares were worth $1, my entire company on the market would be $500 worth. This is why on the news you sometimes hear companies being worth billions of dollars or even trillions. For growth stocks, you're going to have a relatively smaller market cap of about 2 billion to 10 billion. That number still leaves plenty of room to grow to even double, triple, or even quadruple in the future. And for blue chip stocks, which is another way to refer to very established companies, they're going to have market caps of higher than $10 billion. So for example, Microsoft is going to be considered a blue chip stock because it has a market cap of $3 trillion. Now let me tell you one thing that's very commonly misunderstood about market cap. In order for a company's stock price to double, their market cap also has to double, assuming no new shares were issued. So when people say just buy Apple and your money will double in a couple years, another $3.6 trillion will have to be invested into Apple as of February 2025 for that share price to double, which could probably take up to a decade. So if you're looking for quick returns, blue chip stocks with higher market caps are not going to be your go-to because there's going to be a lot of time and money needed to flip your money. That's why growth stocks with a relatively small market cap of $2 billion can be super prone for growth because $2 billion in the stock market are really just pennies. So at the end of the day, the smaller the market cap, the quicker the price can change. So keep that in mind when it comes to evaluating risk. Onto the fourth filter you can use to screen out for stocks will be the technicals. On this page, you can find companies that are either over or underperforming their price history or the market averages. If they're doing better than those categories, they are overperforming, and under would mean they're underperforming. Growth stocks can be either overperforming or underperforming because they're a lot more volatile than blue chip or value stocks. But in the case of value stocks, the investors already believe that the stock price suits the company, so they're going to be a little bit less volatile. That being said, those stocks still have a chance to over or underperform, but they tend to mirror or match the market. And going on to the fifth filter would be the exchange and industry of the stock. Choosing whether you want to find stocks that are either listed on exchange or not can be pretty detrimental. For example, some of the exchanges that are widely used and known, such as the New York Stock Exchange or the Nasdaq, have lots of requirements for companies to be able to list under their name. And that can mean meeting a certain market cap or even a daily volume threshold, but there are plenty of other things that they want. That being said, stocks that are going to be listed in these exchanges tend to be a lot more credible and established, which is great for finding blue chip stocks and value stocks. But in the case of not meeting these requirements, that means a stock would be unlisted or OTC, meaning over the counter. They could still be very credible, but they tend to be a little bit more risky, meaning you have a chance for higher return. But keep in mind, being unlisted is not a bad thing because some exchanges only can hold a couple hundred stocks in their exchange. So it's not uncommon for multi-billion-dollar companies to be unlisted. And then that leads us to choosing the sector of the stock you want. You could choose what type of stocks you want to invest in, such as tech, which is more risky and new, or utility, which is pretty stable and always going to be in use. After all of those filters, you should have a list of stocks that meet your requirements for investing. In the case of having zero results, that means you are too specific with your requirements, so you need to remove or change a few. There is no perfect company in the world, so most of these companies are going to have a little bit of flaw, so go a little bit easy on your screening. From there, you can be extra safe and check their financial statements to see how well the company is performing. Some things that you can look for in the financial statements would be if their net income is increasing after paying their expenses or they're decreasing their liabilities or debts. If you can find a company that's increasing their net income and also decreasing their liabilities, that's a sign it's a good company to invest in. After that, you should have a nice list of companies to choose from. If you want to be extra safe, just wait a couple weeks or months for any news or financial statements to come out to see how well the investors react to those news. If you do end up buying growth stock, try to monitor it relatively often and stay ahead of their financial reports because those prices can change a lot. But blue chip stocks or value stocks can be pretty much left in the background as they're already proven investments. And when it's time to sell, remember there are going to be taxes you have to pay with that sell. If you held the shares for 1 year or less, you're going to pay taxes based on your income bracket on those gains. But if you hold it for more than a year, you'll be paying tax on those gains based on your income, which can be either 0%, 15%, or 20%. And one thing to keep in mind is that you can deduct those losses on your tax bill to the extent of your gain. For example, if I sold a stock this year for a $1,000 gain and then sold another stock for a $500 loss, you can deduct that $500 loss on the $1,000 gain and only pay the tax on the $500. But for more information on that, please consult a tax professional or a CPA, not me. Please, I am not licensed. That being said, using all those tips and tricks in mind will help you find the perfect stocks to invest in. Thank you for watching, and also thank you for all the continued support that I have been receiving on my videos. Let's get rich 2025, and using these tips can potentially get you there. Thank you again, and thank you for letting me be your young advisor. Take care.